Good morning. You're watching The Market right here in ET now with me, Asha Faridi, Aman Dabash, and Nikunj Dalmia also joining in on the show. And it's been a win once again. So India continuously, consistently continues to perform and is charting ahead to the World Cup semi-finals. But that aside, while Friday also was a bit of a respite, it was surely a rough week. You can't really sugarcoat the way we actually panned out last week. Just aligning ourselves with the rest of the globe as well. We managed to snap our 6-day losing streak, but that was only on Friday. We managed to scale back to that 19,000 mark. But for the week, we did even breach that 18,800 print. So it's been a rough one, Nikunj. I mean, yes, there's been a Friday recovery, but one can only keep our fingers crossed that, this week we actually see a continuation of that rebound.
I should not be easy market to call in the short term. I think that's for sure. There are just too many moving parts, and if you align all the moving parts right now, it is evident that in the near term there are multiple challenges which you will have to deal with. So the market environment is sticky. The market environment is perhaps one of those environments where you want to buy but you're waiting for the right price. Now the difference between a corrective phase and a crash is that crash is when there is compulsive unwinding, crash is when you're selling before you're thinking. But this is not a phrase where we are bracing ourselves for any kind of a crash. I guess in the near term, there were excesses in the market which got cleaned out. In the small and the mid-cap space, I think that really seems to be the clear factor which is at play. Globally, one looks at the market, it is evident that the commitment levels have started coming down. The FI positioning in the cash market is reminiscent of how the underlying bearish mood of the market is. So the way I see the construct of the market, Aisha, is that upside is surely capped, downside is limited. Large cap stocks are looking extremely oversold if you look at from the FI lens, so they are due for a bounce. Small and mid cap stocks which are going up as a category in terms of in general approach, you were talking about, okay, small caps are going up, mid caps are going up. Now the narrative could be within small and mid cap stocks, individual stocks in a sense needs to be reassessed. This market has shaken a lot of weak traders, which is good. It has made everybody believe that nothing goes in the straight line, which is also in healthy and good. So I don't see too many fault lines in the market. In my book, bad days you should be a buyer. In my book, this is a time when if you are sitting on some cash, maybe later this week or early next week, even in individual stocks and small and mid-cap stocks, I think you will get a good entry point. I mean, 6 months from now, if we will look at October 2023, I think that would be called as the best buying opportunity of the year.
Yeah, absolutely. But one can't be in a rush to buy this fall, Nikunj, because, looking at the global handover this morning, there is very well a likelihood that we could test last week's lows, that was of 18,850 thereabouts.
That may well happen, Aisha, but if that happens, then you must look at the underlying fabric of the market. Will that get challenged? I mean, will Nifty go down in a linear manner? Looks unlikely because there is liquidity on the sidelines. The FI positioning is extremely oversold. The market conditions are extremely oversold. So a little bit of turn in the global market could actually inject some degree of short covering. Valuations are not that stretched that it really warrants any kind of a sharp adjustment. So I'm not really worried about the construct of the market. Yes, in the near term, the momentum has got challenged, but that's the way it is. B, globally also, Aisha, if you look at it, you've not seen any kind of a linear decline. Currency market is intact. Nothing new has come from the bond market. We've seen routine profit booking in major markets and especially emerging markets. So 2%, 3% here or there, another 2-3%. That after $1 billion 2023 should be considered par for course. So if you're hunting for some margin of safety, I would stick my neck out as I've been doing. Stay with banks. If you're looking for a pocket where I think there are excesses in the market, I would still say that is in some of the pet themes, railways, defense and power. If you're looking for medium-term opportunity, I think pharma is looking exciting, especially looking at the kind of indications and numbers we've got. And if somebody is looking at constructing the portfolio, I think there are a lot of options in some of the new age or perhaps EMS or perhaps some of the manufacturing space where on bad days you want to be a buyer rather than running for cover.
Just taking stock as well as to how things have transpired across the globe, and you had the S&P 500 actually entering that correction zone, which is perhaps the point that Aisha was alluding to. The fact that we did see the US indices wrap up the week at least with a cut of nearly 2%. So that was Friday's move, with the Dow Jones cracking close to 1% or so. Remember, the dollar index as well continues to remain elevated. We'll be closely watching out for the FOMC meeting. Yields as well continue to rise as the core PCE is up about 0.3% on year. Gold is past about $2,000, and oil continues to be on the brink as you've got the geopolitical risk that continues, so nearing $90 a barrel. But that being said, Nikunj, we've been bombarded with a whole host of numbers, the likes of Dr. Reddys, Cipla, BPCL, Bajaj Finserv, this week as well as critical, and I guess Reliance Industries is going to be the big talking point too.
Okay, so Reliance numbers are absolutely in line. If you look at even the verticals, marginal miss and a marginal beat. Net, the numbers are absolutely in line with the estimates. Nothing new has come out, not that market was expecting anything new or grand. So these numbers are unlikely to change the trajectory for Reliance, which is that Reliance is unlikely to suddenly emerge from an underperforming zone to an outperforming zone. These numbers are not going to do that kind of magic for for the numbers per se. The other number which I think Pharma is, in my book, I think is standing out, whether I look at Cipla or Dr. Reddy. I mean, the margin expansion, the kind of indications what we're getting in the US market, the numbers what we got from Taro and then from Cipla and from DRL, those numbers are pointing that things for the pharma space is perhaps bottoming out and it's moving in the right direction. Then you've got Bajaj Finserv, and you've got numbers which have come from IDFC Bank, and those are good numbers. Frankly, they just tell you that the financial space per se, I think, is moving from a the growth phase is just not over. So banks really outperforming. Reliance numbers stable, in line, but they will not excite the market. I quite like what IDFC Bank has done. ET now is coming live from the headquarters of, from the corporate office of India's biggest hotel company, which is IHCL. I think those numbers, even though they came during the market, are, I think it is still encouraging to see the cycle uptrend continues. So it's about picking the spots right now, Avan. Excepting banks, I think in general the numbers have been in line. So which may not really warrant a major uptick per se. But Avan, banks are such a large part of the market that 30-35% of the market, if it is giving you signs of growth, and that gives you this comfort in the market that if banks are doing well and if they're growing without NPAs, that means the bare construct of the market, the consumer, the appetite to borrow and the appetite to pay back, I think that is intact. And for me, that I think is the bigger message.
Absolutely. Well, if you thought last week was hectic when it came to earnings, it's another 14.5% of the index weightage waiting to report its numbers this week too. And you've got the big boys, Nikunj. You've got Tata Motors, Tata Steel, Adani Enterprises, Bharti, and then of course the biggest of them all, L&T, with nearly a 4% weightage on the index.
Aisha, Tata Motors numbers would be crucial, and especially given that how the stock has been a ranked outperformer, and hopefully we will get some clarity as to the net debt plan what they had given to of becoming net debt free by 2025. Are they likely to prepone it? Because the cash flow what JLR is now generating, I think is absolutely amazing. L&T, well, even though stock has been a ranked outperformer, that now becomes like this. Now that is now really the cult stock of the market, so to speak, in terms of where markets are excited about in terms of the positioning of the stock. So yeah, these are two numbers, Aisha, which I think would be crucial. Like I said, that numbers are so far minus banks in line with estimates. They will not excite minus financials. The numbers will not excite a big earnings upgrade. So that really makes this market then in a sense exposed to the fact that in the near term the more weightage actually will come from global cues, liquidity, momentum, not so much so from the earning push. If I keep IT and if I keep pharma and banks on one side, rest of the earnings season has been in line, where IT has been dull, FMCG has been just about okay, and the rest of the gang, consumer names and all, have just given numbers which are in line with numbers. The good news, Aisha, is that we've not had too many companies which have really missed the mark by a margin. Because at this kind of an level, if you miss the estimate and if you miss the number by just a whisker or by 5-7%, then there is no space to hide. So thankfully, touch wood, we've not had a result casualty so far from any heavyweight.
All right, fair enough. That's the view coming in on the overall earnings season too. But let's also find out what the levels are to track back home. And our chartist joining in. We've got Naresh Mirani as well as Kush Bora joining in. Good to have you both on board. Holding on to the 19,050 mark by the skin of our teeth, Naresh, it seems. And it's been what can be described as a pretty choppy and volatile week. Given the fact that now there are concerns of the S&P 500 entering the correction zone, are we worried of some sort of a further fall for our own markets?
So as of now, we are still around that area where we've not seen a sharp cut after the breakdown. So in this case, what do? Is we wait out for a new range being formed. So we broke below that 19,300 mark, which was a support. After that, the next support band is major support band is around that 18,800 and then 18,500 levels. So we made a recovery from those levels on the previous day. So out here, there is a good possibility we could get into a new range, but 19,200, 300 would be tough to cross. Same way on the downside, 18,800, 850 becomes a support, which is important. If that breaks, we could see another 200, 300 points on the lower end. So for now, the trend has changed. We've broken the swing lows. So in this case, let the markets form a range, trade lesser relative to normal size. So as of now, because we've not seen a similar cut happening in the mid cap or the small cap indices. So if you look at the discrepancy in terms of where we are in the various indices, so you have Nifty around the 200-day moving average, Bank Nifty below the 200-day moving average. Then if you look at the mid cap and the small cap indices, they are closer to their 50-day moving average. Even in terms of sectors, you have auto, which is above the 50-day moving average. So there is a lot of divergence. So the momentum is not that strong on the downside, but we've broken the lows, the recent swing lows. So for now, expecting range bound moves, time to be a lesser on the trading side, reduce trading size and wait it out, let it form a new range.
Right, okay. Kush, let's get in a word on the small and mid caps, considering they were the more battered and bruised ones. What's the likelihood that maybe the rebound will continue from Friday, or we could even test the Thursday lows?
So, hi, Ayesha. First up, very good morning to you, all the viewers, and thank you for having me on the show. Well, I sort of agree with Nuresh here that, Nifty, Bank Nifty perhaps is in a no-trade zone, or if you really want to trade Nifty, Bank Nifty, you could perhaps have a lighter position. Mid-cap index, on the other hand, is a very different setup altogether. If I look at the fall on the index, it started from 41,500 odd kind of levels. Even now, for the year, we are close to about 20% up. So definitely there is strength, in this space. Even on Friday, we saw a very sharp rebound in, a lot of select names. So I think this momentum could continue. This could now very well become a stock pickers, market, since the indices will perhaps, be either, consolidating or have a slight negative bias given the geopolitical issues and everything that's going on in the US right now. So this will become a stock pickers market. For me, mid cap is the space to be, and I will have a lot of stocks on my radar if I'm actually looking for buying opportunities. Mid cap is where I will actually try and hide, or if not, look for more money making opportunities. So certainly Nifty, Bank Nifty is something that's in a no trade zone, and mid cap is where all the action will be going forward, at least for the next 2 to 3 weeks.
Okay, mid-caps is where all the action will be. We'll find out your stock ideas, but first, let's get in Naresh's take in terms of individual stock recommendations too. Naresh, what's on your radar?
So being stock specific here, looking at stocks more from a defensive bent of mind. So first is a buy on Dr. Reddys. The stock is at the lower end of the trading range, has been a relative outperformer, and is making a flag formation. Ideally, the flag breakout comes at around 56.50. So it's ideally a buy above those levels, but for now we are expecting a bounce towards those levels in the next couple of sessions. So stop loss at 53.50, target price of 56.50. Second is a buy on Tata Power, which is a stock on a retest of the previous breakout points, corrected well from those 270 odd levels. A risk reward trade here, stop loss at 230, a bounce back, target price of 255.
Kush, what stocks would you recommend this morning?
A couple of them, both of them have a very similar setup where they've not really lost steam or momentum despite the market correction. The first is L&T Finance. If you see, the stock was gaining traction, just before the market sort of went into a tizzy, but the rebound on this has been equally sharp. So L&T Finance could resume, its upswing once the market stabilizes, which it perhaps will, or at least go into a consolidation mode. The Nifty and the Bank Nifty, as I said. So 141, 144 are the near-term targets that I'm looking at. 134 is where I would place my stop loss. My second pick is Astra Micro. Fairly similar structure here as well. The stock was doing well. It only saw the dip, in line with the markets, but the rebound was equally sharp. So 485 and 510. These are the two levels on the upside. On the downside, 450 is where I see a strong support zone.
All right, there you have it. Those are some top recommendations. Kush saying that his focus is on the mid-cap space. But one can't forget the memorable sporting action that took place with the World Cup fever as India continued its supreme run in the ongoing World Cup. We actually beat England by 100 runs in the low-scoring thriller. Leading from Team Rohit, he scored 87 runs, helping India pile a respectable 229. England, in response, failed to resist the Indian attack that was spearheaded by Bumrah and were bundled up for just 129. Remember, India has now won all 6 of their matches. We stand at the top of the table with 12 points. The next match is going to be against Sri Lanka on Thursday. That's going to be very closely watched out for. All right, away from all that cricketing action, we couldn't help but just flag it off given the momentous 6-run win. And let's talk about individual stocks then. Anisha Jain joins us right here in our studios to discuss that. And Anisha, let's begin by talking about AU Small Finance Bank with respect to their acquisition.
Oh, well, yes, the numbers were a bit on the weaker side, but the acquisition is something that you need to watch out for because that might just keep the stock markets more interested today. Just quickly talking about that, Fincare Small Finance Business is what they've acquired and they're going to merge it into AU Small Finance Bank. They're going to give out 579 shares for every 2,000 shares that have been held in Fincare Small Finance Bank. As a result, if you look at the valuation metrics, the Fincare Small Finance Bank is valued close to around 4,400 crore rupees because the price to book is almost 3x the trailing 12-month book that we have seen for Fincare Small Finance Bank. Now, post the transaction, the existing shareholder of Fincare Small Finance Bank will hold almost 10% stake in AU Small Finance Bank. This is, of course, going to be accretive on the book value for AU Small Finance Bank to the tune of around 7.3%. But the other thing that the street is watching out for is also the geographical integration, because if you look at this latest acquisition, that has further presence in southern part of the India, where as of now we haven't seen much presence come in from AU Small Finance Bank, and even on the eastern side they're quite strong. AU Small Finance Bank, of course, has been on a lookout for this acquisition, but one needs to watch out for what happens to the asset quality, because apparently the slippages are a bit high for Fincare, as well as the return on asset. How will that metric pan out is something that we need to watch out for. But AU Small Finance Bank had seen a massive run up since from the levels of around 230 thereabouts, but since then it's been seeing a bit of a consolidation at the 700 rupees range. Let's see where it goes from here.
Oh yeah, absolutely. That's going to be the stock to look out for, as would be Indian Hotels. Nikunj, of course, is going to have an exclusive interaction as well with the management one-on-one. But yeah, brokerage is liking the performance, Anisha.
Yes, we expected that it's going to be a good quarter, and in fact Q3 is also something which is going to be quite good, and the outlook also is something that they've talked about in the second half of the year, which is going to be quite strong. They delivered an inline consolidated revenue, if you have to call it that, because the occupancy was close to 76% thereabouts, and that compares to 70% that we had seen last year. The average room rate as well as revenue per, if you look at that growth has come in at 18% as well as 28% respectively. So the consolidated margins have slightly disappointed the street a bit. Having said that, the growth outlook for the second half of the year remains very strong. The business on the book is strong. The Ginger business is also kind of turning around quite a bit. So overall operational efficiencies are setting in, and they're also talking about expansion in international geographies. But that has been a bit of a drag for the business. So Aman, you track this one also very closely. It's your take in terms of what brokerages are saying, and anything specific that catches your attention?
I think the fact that the EBITDA performance was good was an offsetting of what we saw with the US operations. There was an EBITDA loss of about 27 crore crore rupees. So that was a bit of a disappointment. And the management has acknowledged that going forward as well, they will see some challenges when it comes to San Francisco. They said it'll take 3 to 5 quarters for the market or the hotel to really come back. So that's a bit of a challenge. But other than that, Anisha, as you said, we were going in with expectations of inline numbers, and that's what they delivered. They've guided for double-digit RevPAR growth as well in the next quarter and in the next year.
Yeah, and we're headed into the seasonally strong quarter any which way. But that said, we're going to take a very quick break. Anisha, thanks for highlighting all those stocks. When we come back, talk more markets and analyze lots more earnings.
Thanks so much for staying on with us, still tuned in to First Trades. And let's put the spotlight then on Reliance Industries, talk a little bit more about their quarterly performance and what the street makes of it. We've got Harshvardhan Dole, he's joining in, Vice President at IIFL Securities. And I think the key talking points were that you had the profit growth coming ahead of what the street was expecting, and that was largely driven by the O2C and the retail segments. How have you read into those two segments and the kind of quarterly sequential growth we've witnessed?
Hi, good morning. So one key highlight for the quarter has been the growth in EBITDA and reported profit has been more or less the same. If you were to analyze this trend for past several quarters earlier, the EBITDA was growing at a much faster pace than the PAT, largely because of rising interest cost and depreciation. This has been reversed from this quarter, largely because of the operating leverage, which has kicked in on the retail side, and partly because of also Jio. I'd also think that stronger performance in ENP has also contributed to this kind of performance. So a great performance from all the segments. That's how we read the 2Q results which have gone by.
Harshvardhan, hi, morning. Thanks so much for taking the time out. I know we rushed you up from your morning meeting. But specifically about retail, because I was just looking at the SOTP valuations as well. Retail is now the most valued entity or highly valued entity amidst all the segments that Reliance operates in. Specifically, tell me about retail and whether that's coming at a surprise on the upside for you, and whether this is going to continue to be, the focus area from Reliance's stable and continue to perform better.
You're absolutely right. If you were to, look at the SOTP, retail contributes the highest as of now. Now, one should bear in mind the stake in retail is also higher as compared to Jio. So the attributable value by default will be higher than that of Jio. That's point one. Secondly, performance of retail has actually surprised the street and us as well. Perhaps what has happened is the share of matured stores in the overall pack have started to rise now. And that kind of leads to a natural operating leverage, which in my opinion should actually sustain and accelerate going forward, particularly in the festive seasons. So while we are surprised in terms of retail, I think the third quarter could be even stronger as compared to second quarter if you were to read the underlying currents which have been presented by the management in the earnings presentation.
What is the outlook then when it comes to overall Jio's performance? Because the 14% inline EBITDA growth could largely be attributed to the subscriber additions. What's the road ahead when it comes to Jio's performance?
So when we are looking at Jio, we are looking at close to about 18 to 19% EBITDA growth for the full year, which does not bake in any increase in ARPU. And we are assuming that only the subscriber growth kind of propels the EBITDA for the full year. However, when it comes to FY 25 and 26, in addition to the subscriber growth, we are penning in close to 10% ARPU growth beyond FY 24. And if that actually pans out higher than what we are assuming, that will not only lead to earnings growth, but also materially higher cash flows and improved return ratios in the later years.
Harshvardhan, given that the valuations are comfortable on Reliance right now, stock has underperformed for the last 34 odd months. I'm guessing you must have upped your price targets too?
So we have kind of held our price targets, and we think that the underperformance should end now. largely on account of the business momentum which has started to be visible. And secondly, the commentary from Reliance CFO has been quite encouraging. While he's maintained a very bullish tone on the underlying businesses, I think after a very long time, we got to hear that the capex for the company is likely to recede in the subsequent quarters. And were that the case, I think the cash flow generation should be much, much higher than the EBITDA growth, thereby leading to a much stronger balance sheet and hopefully a better return ratio profile in FY 25-26. And these are the attributes that typically should re-rate a mega cap stock like RIL, which, as you rightly said, has underperformed for a very long period of time. So we are hoping that the underperformance should start to reverse essentially from second half of FY24.
Very much for putting RIL's numbers into perspective for us. Let's move right on and welcome on board Sanjiv Bahl, who's now joining in on the show. Sanjiv, good to have you on board. Maybe the markets are playing catch up, but we sure are, having a stellar performance on the cricket stadium. We're bleeding blue and how?
Yeah, morning, Avan. That was a welcome surprise yesterday. And first time we batted first, and I thought we, performed slightly poorly given our outstanding performance. But the bowlers, they really did us proud. So I think, Avan, for the first time, I've seen such camaraderie in the team, and every department performing. So thumbs up. I think we are going to be the world champions, and the 6-leg streak of wins should now convert into even better times, and hopefully that should play out rub out some good effects on the market, where we had six large long days of fall, and I think the results are actually telling you that believe in India blue.
There are times in the market where everything is looking good, but stocks they correct. And are we going through that phase of the market where numbers are okay, banks are strong, but you will still go through a phase of compulsive correction and you need to accept it?
Correct. Good morning, Nikunj. That is the part and parcel of volatility and some, external risk which always plays out. You've seen the numbers from Reliance, from Canara Bank, from Ultratech, from Maruti. It's not just one sector or stock. It's a breadth of the market. And I think that midcaps are also delivering, which is why if you thought there was froth, I think that is unwarranted. I think the broader market, particularly the Nifty and the Bank Nifty, given the spate of earnings and the growth outlook and the seasonal factor, is all looking very, very hunky-dory, Nikunj. We know on the 1st, the Fed is going to be on hold, and the dovish nature of his speech now, given that yields are closer to 5%, should actually abate. Plus, hopefully, there should be some faster resolution on the ceasefire in Gaza and so on. But, we've learned to live with it. How long back have you started to talk about Ukraine and Russia? That's in the past. So I think sooner rather than later, market will focus on better micro earnings. And if anything, I think Reliance needs to be re-rated, which should actually give a leg up to the index, definitely. So I am very, very bullish on both the indices, Nifty and Bank Nifty.
But technically, Basin Saab, the view is very different. Nifty has struggled to cross 20,000. We've gone below key technical levels. And if the SGX number or the GIFT Nifty number is anything to go by, we will have an opening in and around 19,000. So does it make sense to go against when the technical setup, at least in terms of the short-term momentum direction, is not favorable?
Yeah, Nikunj, that will always remain a question mark, because I thought that the last 6 days were very, very excessive in their nature of a fall. More due to expiry, more due to a lot of technical factors. But, Reliance, HDFC Bank and maybe a lever have been part and parcel of this larger than expected fall. Now, I am not making the case that outrightly, but remember, in a bull market, these type of corrections also see sharper than expected rises when they come. Secondly, Nikunj, in the last 3 years, we've been in the 17 to 20,000 range, but quietly earnings have started to grow. So now your multiple is not all that expensive, which was touted to be. And I would say that little bit of stability globally. India sets to be the outperforming index. November will maybe a much better month than we thought. And as we get through this event risk of the Fed and so on, I think numbers will continue to flatter on the upside. So I can hold my neck out. I think this 18,800, 900 may be retested because of a technical parlance. But these again are buying opportunities given the macro and the earnings trajectory seems very, very positive. And the outlook also is even more positive than we imagined. At a time when global risk is far, domestic consumption is playing its, is playing the best play globally.
Okay, I'm just going to change gears and talk about some specifics here. And the specifics, Nuresh, some would argue really would be which way Reliance would move and which way HDFC Bank would move. Nuresh.
So technically, if we look at it as of now, there is it's been a clear-cut underperformer, and the price action continues to be lower. So if you look at HDFC Bank, it broke the recent swing lows also, which is where it bounced back from that 1490 levels. So technically, it remains weak. The previous gap up moves, etc., have been broken down. So ideally, the trend remains down. It's only when we start making a move beyond 1530 is where we change our view. Now, whether it stops at 1400 or at current levels is tough to say, but the trend is down for HDFC Bank. The stock is back to the prices where it was pre the merger announcement. The lows post that were closer to 1300. The last swing low, major swing low in that period is closer to 1350, 1400. So technically, the trend remains weak. So unless we cross 1530, would not be looking at it. On the same side, Reliance Industries has been a slow and steady downtick here as well. But it's not been a sharp correction. It's been a very slow and steady correction ever since 2600 odd levels. In the near term, there is some bit of support around the 2200 mark. So till the time 2200 holds, we could be seeing some bit of a bounce, but overall, it could be a range-bound stock 2200 to 2350. So not bearish per se on Reliance Industries, but not really a trade here.
Okay, that's the take coming in on Reliance. Indian Hotels, that's going to be the other stock to look out for. Sanjiv, Nikunj is already there at the IHCL headquarters. He's going to be chatting with Puneet Chatwal as well shortly. But what's been your reading of the numbers? While, of course, the US operations were a little bit of a drag, but the India operations are roaring to go. And, you know, the good thing is that the strongest of the quarters is up ahead.
Been the star performer, and it's telling you that average room rates were at an abysmal low during the COVID and the pre-COVID period. You can't get room rates up to 35,000. Mr. Chatwal met me some months back and said, I wish I had more properties in Bombay and Delhi because capacity is running full. You just go to the lobby of Taj and you'll imagine what the buzz around is. There is no place to stand. I mean, literally speaking. And it tells you that entertainment and travel and tourism are actually at the best place ever, and yet raring to go, given that in Delhi now there is a spate of weddings. Your bookings are for banquet halls and the likes are actually at maybe just starting to go reach highs. So I think this is a very, very sweet business. Tatas have been always at the forefront, and I am very, very bullish on this stock itself, which also means that the spending patterns and the consumption patterns are very, very positive. So domestic growth is going to be the key. We'll hear more on what the US operations is, which could have been a one-off, as there is some sort of weakness in the US, and that could play out because of higher inflation. But locally, the top pick continues to be Indian Hotel.
But isn't that price to perfection now? The template that Indians will travel more, Indians will move out more. Isn't that in the price? And also going forward, there will be no upside which will come from G20 and Cricket World Cup.
Yes, you could argue that, Nikunj, but that is what we felt has always been the case for a Nestle or for a Maruti or for an Indian hotel. Pedigree stocks with business outlook and transparency and forward-looking guidance will always trade at perfect to prices, but they always supersede those prices. So Maruti has hit is closer to 11,000. I think 12,000 is very much on the card. Nestle is close to 25,000. I think 27,000 is a possibility. And thirdly, again, Indian hotels. So like you said, yes, a large part of it is in the price. But if you want to be in the pedigree businesses and in the, want to participate in the India story with a slightly longer term view, these are three stocks which must be in your portfolio.
Suresh, Maruti, I mean, it's just been a standout. I mean, I would say that if I look at the recent leg, it has underperformed Tata Motors. But last couple of days, it has gained elevation. Do you think Maruti is on course to move to, let's say, 12,000, 12,500 soon?
So yes, Maruti and the whole auto pack has been a relative outperformer to the Nifty. The whole auto pack as such trades above the 50-day moving average, and the Nifty is at the 200-day moving average. Now, going forward, Maruti has given a breakout, which is almost 5 years. So the last time it was at 10,000 was back in 2017, 2018. Then closer to 8,000, 9,500, 900 in 2022. Then in June, July, we came to that 10,000 mark. So now it's broken that 10,000 mark after 4 or 5 attempts in the last 5 years plus. So it's a breakout. Did a retest also recently a few weeks back. So overall, structurally, this would imply that it's a trend which has started, which could last almost a year and go much higher going forward. So 12,000 would be a distinct possibility in the short to medium term. And a stop loss would now be placed at around 10,000 odd levels. So it's a buy at current levels as well as on dips with a stop loss below 10,000 and a target price of 12,000. And the whole auto pack looks interesting as such.
In fact, since we're on the subject, let's also hear out what R.C. Bhargav had to say about the numbers.
During this half year, crossed the 1 million mark. We had been waiting for this to happen earlier, but various factors had come in the way. This semiconductor crisis, mostly responsible. It had set back our things because we had hoped to get to 2 million much earlier. But now that we've crossed 1 million in the first half, the probability of crossing 2 million during the year is very, very high now. We are looking forward, and we hope that during this year we will get to that landmark.
Okay, that's the take coming in. And Maruti, remember this week you've got Tata Motors as well coming out with its earnings. But Sanjiv, we'll let you go on that note. Thanks as always for taking the time out and joining in. A week handover, and I just want to revisit what the Nifty implied open is indicating. So from the levels where we left it off on Friday, seems like we're going to consolidate around that mark. But yeah, on a net basis, it's a 47-point decline that you're seeing, 19,097 for the Nifty right now on the gift Nifty. But with the correction that played out in the broader markets all through last week, what should investors be doing? That's exactly the question that we asked all of our experts who joined us all through last week. Here's a slice of what they make now as to what investors should be doing, whether they should be staying away or using these declines as buying opportunities.
The small cap index itself chugged so much that the stocks that finally make that cross that high again are a completely different set from the stocks that fell. The stocks that fell, a lot of them just go out and go to zero essentially, stop trading, etc. So that part of the market I've been saying for the last month and a half, that's where you have the real risk part. The large caps, of course, you have to choose the sectors carefully, you have to choose the companies carefully. I and my systems also don't still like private sector banks. In fact, the last rebalance we did, we cut back banking in general, and within banking, again, skewed little more towards PSU banks.
We like pharma as a sector because we think there's earning resilience in the sector. And more importantly, the sector is coming out of 2 years or 3 years of underperformance and business challenges. And now a lot of those headwinds which the sector faced has turned into tailwinds. So we see good opportunities in pharma across both large caps as well as mid caps, and valuations there are far more reasonable. And apart from that, we like some of the mid-cap banks as well, financials as well, because we think asset quality in the sector as a whole is extremely strong or resilient.
We have been a little cautious on the broader market space for some time now. And our broader concerns were that the valuations had become too rich and greed was clearly visible on the street and money making had become too easy. Over the last decade, mid and small caps have been the best equity class. And we believe that some exercise and some caution needs to be warranted in the near and short and near term. Even if you look at large cap market cap ratio versus GDP, it has come down to very reasonable levels. And we believe that some, rotation may happen from mid and small cap in the near term towards large cap, which are in a much better valuation zone.
All right, let's also bring on board Sandeep Sabharwal, who's joining in on the show. Sandeep, hi there, good morning. Lots to chat about, given that we did have a whole host of big numbers, as well as it's going to be a hectic week going by. Let's get in a sense as to what you made of the pharma majors. You had Dr. Reddys that put out numbers pretty much in line with what the street was penciling in, and Cipla was fairly strong.
Yeah, both results were pretty decent. Drivers for the results were different for different companies. Some due to higher product prices, some due to lower input costs, and due to OPEX control, etc. But overall, the large cap pharma basket in terms of result typically has been doing better than expectation, and that's also reflected in the outperformance of some of the stocks. Now, at the current levels, these stocks seem to be in the fair value zone. With the view that on dips they should be bought, and they should be bought rather than looking at selling them on that.
All right, in fact, let's put the spotlight then on these pharma majors and hear it out from the management. Umang Vora, the managing director of Cipla, talking about the Q2 numbers. You also have the management of Dr. Reddys. Listen in.
Revenues was up close to 15 or 16%. Profits grew significantly more than that. I think we've continued to show market-beating growth and traction in all our businesses. We've shown it in India, both in the branded prescription and the trade generics business. In our consumer business, we've seen the same effect that the FMCG companies saw, which was of a slightly slower growth, but I think we're beginning to see that bounce back in this quarter already. I think this quarter had the impact of, obviously of the liquidity situation and a little bit of volatility due to the world context. And in South Africa, we continued the robust performance. The business is growing on the back of strong private market growth. We continue to fund the R&D program at the company. We are now at about 5.7% of revenues. The spending grew by almost 13% versus the year before.
We actually have an EBITDA of 32%, which is very healthy. And plus those margins grew by high double digit. The profit after tax even grew by 33%. So I think for both profitability as well as the growth of the profit, we are in a very good shape. The return on capital employed was 39%, which is also, I believe, very, very healthy. And likely that this performance will proceed also in the future. Most of the growth was volume growth as well as market share, as well as contribution from main. These were the main lever, and of course we will help that the level of price erosion is moderated compared to quarters in the past. The growth is coming primarily by giving better service to customers and growing base products that enjoy the fact that we got that service and we were able to pick up market share on those.
All right, those are the pharma majors, keeping the spotlight on them. But getting a take then as to what exactly you're penciling in, Sandeep, when it comes to Tata Motors. After a pretty solid set from Maruti, Beverages giving it a thumbs up. What's the expectation from heavyweight Tata Motors?
I guess Tata Motors results should also reflect similar improvements. Although on the domestic front, Maruti would have done much better, but on the global operations, Tata Motors performance is expected to continue to improve with improved margins and improved cash flows. I think the key in Tata Motors, which everyone tracks, is the order book and the cash flows plus the net debt levels which the company has, which they have been continuously indicating they'll be reducing gradually. So those are the parameters to watch. But overall, trend-wise, things looks to be positive. Maruti results are very strong. Bajaj Auto results are very strong. So auto as a segment, as the industry seems to be doing well at this point.
The charts indicating when it comes to a Westlife food world at about 8:20 after the decline we witnessed on Friday's trading day. Good time to nibble in. And have you had a look at the charts of an IGL?
So technically, both these names have seen a sharp cut over the last few sessions. You don't want to be buying into a sharp cut unless we start seeing reversal signs. So we've seen a 3-day cut on Westlife. Same is the case with IGL. The stock looked interesting and was on verge of a breakout around 480, got stopped out. And then it has broken all the major swing lows of the last almost 3 to 6 months. So I would still be a little cautious. The stock has been an underperformer. Every time the stock tries to come back, we've seen corrections. The stock is now closer to a support level of 340 to 360, which is a very strong band because that was the low of 2022. So do not expect much of selling pressure from here, but a recovery would wait for some reversal signal. As of now, we've not seen any.
Okay, fair enough. That's the view coming in on the charts. On the flip side, though, on Friday's trading day, you had something like a Wellspun India, which shot up. EIL was up and away. Varun Beverages gained traction. Something like a Jamna Auto, Adani Total as well. Those were some of the smart movers on Friday's trading day. Just Kush, wondering if you've had a look at any of these charts, anything catching your eye?
Something like Varun Beverages. I've got something. One of those stocks on my radar does look like it's probably going to hold on to these levels. We saw consolidation. There was a breakout, but that's more in line with the market, and the recovery has also been fairly decent. So that's something that I wouldn't mind dipping into on the buy side. On the upside, 950 and 980 are the two levels that we're looking at. And on the downside, a 910 or a 900 kind of a level is a support zone. So that's where I would place my stop loss if I take a fresh trade, from here on.
Okay, fair enough. That's the view coming in on the charts of Varun Beverages. But let's move right on then to some more news and updates. And after a successful reverse merger, Max Estates will list on the exchanges today. How does the new structure at Max Ventures affect shareholders? My colleague Vamakshi joins in to explain. Vamakshi?
Well, yes, Max Estates in focus today. The company is expected to list on exchanges today, and this is after completion of reverse merger between Max Ventures as well as its subsidiary Max Estates. Now, the composite scheme of amalgamation was approved by the NCLT bench of Chandigarh back in July 2023, and in fact, the trading consequently of Max Ventures was suspended on August 10th, mainly on account of procedural reasons, and the share price, in fact, on that day was around 216 rupees per share, which was an all-time high as far as Max Ventures is concerned. Now let's look at how the company structure has actually changed over the last few years. Now earlier the company had two business segments. The first one being the specialty packaging business, which was a JV with a Japanese firm, Topan Printing, and the second was the real estate business which it owned through its subsidiary, that is Max Estates. Now the company had actually divested its entire 51% stake in the JV for specialty packaging for around 600 to 650 odd crores, and this was mainly to focus on the real estate segment. So essentially Max Ventures became a holding company for Max Estates, with real estate being its only business. Now the idea behind the reverse merger that the company shared was to actually remove the holding company structure and directly list the real estate company. The conversion ratio for the same is 1:1 ratio. So essentially when we talk about the impact on the shareholders, for existing shareholders of Max Ventures that will get shares for Max Estate, nothing materially changes. It is only technically that the name is changing for Max Estates. So all in all, keep an eye out on Max Estates on the back of its listing on both the exchanges.
All right. Meantime, Sandeep, just wanted to get in your take as to what's happening when it comes to some of the chemical stocks, the likes of Naveen Fluorine, SRF, Gujarat Fluoro. Some of them seem to be in a bit of a downtrend.
So I think the chemical space is in a perfect storm at this stage because prices are declining, demand is falling, and the supplies are very huge. And on top of that, many of these chemical companies have announced very large capex plans. And once as those capex plans will hit the markets, that be at a time when the margins are actually getting squeezed. So I think it's a perfect commodity cycle where the chemical companies become most aggressive at the peak of the cycle, start doing a lot of capex, and then you have years of downtrend in prices as well as profitability. I would think that many of these stocks which have fallen substantially from the tops can also fall substantially more from current levels. So people could be in general cautious of the chemical space. There could be a few exceptions here and there which are doing something different, but overall that's the
Fair enough. That's the view coming in on some of those chemical stocks. Meantime, there's so many stocks that we'll really be keeping on our radar, tracking the quarterly numbers. You've got Aztec Life, for instance, came out with a loss of 13 crores this year versus a profit last year. On an operational basis as well, it was a loss of about 3 crore rupees. There's M&M Financial Services, where the profits were down nearly 42% at 287 crores. We'll be watching out for a City Union Bank. You have the asset quality, which has moderated sequentially. Profits just about flat at 281 crores. MGL is the other one. Profits have been disappointing, down about 8% YOY, but the total volumes have seen a near 5% increase. That's MGL as well, that we'll keep an eye out on in trade. And IRB Infra, another result candidate, ditto when it comes to a blue dart, where you have seen their margins shrink this time, and revenues have been absolutely flat at about 1324 crore rupees. Route Mobile is the other one that we'll be tracking. A profit at about 88 crores has been down nearly 3.5%, and margins have shrunk to 12.6%. Sandeep, wanted to get in your take. Some of these mid-cap PSU banks, how have you read into the quarterly numbers? And do you think that when it comes to the pecking order, it's definitely going to be the large caps, that private banks, that will take the lead?
I would think so, because see, the PSU bank current results seem good simply because of the fact that the write-offs have moderated, there are some recoveries, etc. But these banks are continuously losing their market share in the low-cost deposits, which is the mainstay of banks, which is the sort of fodder for banks to make higher profits. And there, the private sector, larger private sector banks are gaining market share on a continuous basis. I think that's the challenge in PSU banks will face. So I would think they have had a huge rally. The valuations are not as cheap. And my preference still would be banks like ICICI or Axis, which have done very well in outlook also very positive.
All right, there you have it. Meantime, Kush, wanted to understand from you as well what the outlook is on some of the large cap stocks that were standing out on Friday's trading day. Axis Bank really taking the lead with a 3% gain, and you also had something like an SBI that was a buzz.
Quite rightly pointed out, I think Axis Bank is perhaps going to be, one of the outperformers in the private space. We know the issues surrounding HDFC, and, doesn't look like, it'll rebound anytime soon. Been under a lot of pressure. ICICI, Kotak have, issues of their own going on. So I think Axis is actually our top pick in the private bank space. Not a bad idea to perhaps consider this on the long side, especially if the Bank Nifty were to rebound. I think, Axis Bank could play a meaningful role here. On the upside, I think 1030 and 1055 are the two levels that I'm looking at. And on the downside, 975, 980 is the zone that, could hold as a support zone. As far as SBI goes, well, the entire PSU bank has been, PSU bank pack has been under pressure. SBI is, no different here. The Friday rebound, in line with the markets, was more of a technical rebound. So I wouldn't really buy into, this, rebound. As long as the stock holds above 575, or when it crosses 575 is when we can consider a long position. Otherwise, this stock will remain in a downturn. Not a bad idea to perhaps even go short on it, till it crosses 575. So SBI could remain under pressure for, some time, but Axis Bank looks strong.
Sandeep, I recall, last week during the declines, you said that, you could add up banks to your existing positions or maybe even buy afresh. And ICICI Bank and Axis, I think, were the preferred ones. But what within mid and small caps, if at all, you recommend buying into the decline?
In the banking space, I personally don't go into mid and small cap banks because I believe the larger banks, unlike many other in market segments or industries, the larger banks tend to do well over the longer term. So that's how I'm seeing, and especially at a time when interest rates are high, etc. Many of the smaller banks have been growing on the back of personal unsecured loans. So we don't know what ultimately will happen to the asset quality. So it is time to be stick to the leaders, especially in the financial space.
And X of banks, anything that's looking interesting, anything that you may have bought in last week's decline?
So mainly banks and like I've been saying that on autos, things are looking positive. So Maruti, I think, is still pretty well placed even at these levels to give a 15-20% kind of return for the next 1 year. So that's one thing which we've been adding.
Again, Sandeep, within autos also, there's quite the shift which is happening. You've got Maruti, which is now well above the 10,000 mark. You've got a rebound coming in a Bajaj Auto, for instance. So where within autos is your preference?
The autos, overall, I think the entire space will do well. Maruti stands out because it's underowned stock today, and many people have not bought into the stock because the delivery was not coming in terms of results, and this quarter suddenly they have delivered very strongly, which changes the earning picture completely. So I think that's one stock. M&M we've been holding. Tata Motors is something we've been holding. Bajaj Auto, unfortunately, I have not been holding, but I think the company is doing pretty well.
I wonder if anything within the primary markets or any of the recent listings have caught your eye, because there's really been a flurry of activity within that space.
I agree, and valuations of these companies are just too high. Even the two recent IPOs which are on or coming up this week, with most of it being offer for sale, I think the valuations are too high to justify investment. So we need to see them cool off, like all of us remember the IPOs of Nika and Paytm, etc., and what happened subsequently, and then it presented opportunity to buy for investors much later. Many of these IPOs, I think, will go the same way.
Right. Okay, Sandeep, good to have you on the show as always. We'll let you go on that note. Just mark the pre-open rates, and it seems like we're headed in for a rebound. Good to see that 19,100 at least is back on the ticker. It's a 50-point, uptick, not a meaningful one at that. But let's see how the rest of the day pans out. Want to quickly check in on what Reliance Industries is up to and how that stock is reacting to its earnings, which were largely in line as said. Retail, of course, was a beat, so good 1.5% of an up move coming in on Reliance, and I think single-handedly that must be cushioning or providing that leg up to the index. A couple of other names which are also going to be in focus, and a lot of earnings coming in by this Gujarat Gas, wherein the company has announced an increase in industrial gas prices. So look out for what that stock does. 0.6% of a move. AU Small Finance Bank, of course, is very critical as well. They're looking to acquire Fincare Small Finance Bank as well. That stock is lying absolutely flat right now, and I think there was a red tick just a short while back. There's also Ultratech Cement, wherein the board has now okayed approving the capex of 13,000 crore rupees to increase their capacity even further to about 21.9 MTPA. So that's another stock which is in focus. And yes, lots more numbers. Root, we're going to be chatting with the management too shortly. There's IIFL Finance. Jefferies has now initiated a buy with a target price of 760 on this particular stock. There's IRB Infra, which has received a letter of award from the National Highways Authority of India. That's NHAI. A big gap up move on IRB Infra, 6% higher as we speak. And then, of course, DRL. I think that's the only souring news this morning, wherein the US FDA has now issued Form 483 with 10 observations for their manufacturing facility in Hyderabad. So that's a bit of a weak link this morning. Let's see what L&T, Tata Motors, etc. are up to ahead of their numbers due this week. Those stocks will just come up for you on your screens. There's, of course, Cipla as well, which has raised its margin guidance from to now 23 to 24% kind of a range with a higher end bias from the earlier 23%. Cipla as well starts off with a gain of about almost 1% this morning. NTPC, the numbers were largely in line. The margins have come in at 25.7 versus 22.3. So I think that should go down well with the street. In any case, this has been a performing stock. Almost a 2% uptick is what you're seeing on NTPC. There's Inox Wind. The losses have narrowed for them this quarter. I think that should go down well with the street as well. And then, of course, Route Mobile, like we flagged off, those are also numbers which came by. There's Oberoi Realty as well, by the way. The margins have expanded quite a fair bit to 52.4% in the second quarter performance. That stock as well jumps up higher by about almost 1% as we speak right now. But yeah, there's Union Bank, there's Good Luck, there's City Union Bank as well, there's Iron Exchange, lots of mid-cap numbers which have come by post-market hours Friday up until the weekend. So yeah, there we are discussing all those. And of course, BPCL as well. The GRMs have come in at about $18.5 per barrel versus the estimates of 16.5, and I think that's going down well with this street. M&M Finance, SBI cards, those numbers haven't quite met up with the street expectations, but you don't know how the stocks are going to move. M&M Finance down 5.5%, SBI cards uptick of about 0.5% or so. But Kush, what do you think is going to, dictate the market mood this particular week? Does it seem like it's going to be largely the earnings, or could it purely be the index move? That's, how your Nifty and the mid-cap index pans out.
I suppose a lot of the earnings is now out of the way, with a lot of big names having delivered the numbers. So I think that is although there is still some of the big names left, but I think that perhaps has sort of played out now, and not a whole lot of them have had a major miss. So I think it's now the technical aspects that will start playing on the markets. As we said, 19,200 and 43,200 on the indices sort of seem like a crucial a roadblock to sort of cross. So I wouldn't be the first one to sort of jump and buy on this dip, even if today we had about 100-point gap up on the Nifty, which we don't apparently, it looks like. I wouldn't have really gone ahead and bought into this, because this could very well be what we call as a suckers rally. So being a little cautious on the index, I think from here on, the kind of option writing that we are seeing and the other technical aspects will perhaps play a little more than the results themselves. Now it's only stock specific action that will come about from the result specific action, but it's more of the technical factors that will start playing on.
Thanks very much for that. Let's move right on then. And we've got an ET now exclusive. We're learning from reliable sources that Reliance Retail and LVMH have begun talks again for the rights of Sephora's India business. The deal seems to be close to concluding. We've got Aishwarya Patil here with the details. Aishwarya?
Hi, very good morning, Avan. So we've learned from our sources that Reliance Retail and Sephora, as you mentioned, the parent LVMH, have begun negotiations once again to secure rights for Sephora's India business. We've also been given to understand the deal talks are in advanced stage, and it will be inked as soon as, or at least in the next 3 to 4 weeks, we'll be hearing about the deal being signed between the two entities. Now, remember that the discussion of Reliance taking Sephora's franchise in India began first in September of 2022 to secure the master franchise and bring that into the fold of Reliance Retail, but that deal did not fructify earlier. Also, if you remember, Sephora is a brand which is owned obviously by the parent company LVMH, and it's currently being operated by Arvind Fashion Limited, Arvind Fashion, and has about 26 stores in the country currently. In fact, the research suggests that Sephora's revenue is all set to grow at 9% CAGR going forward. As well as in FY23, it's expecting a EBITDA margin expansion of 25 basis points going forward. as far as Reliance Retail is concerned, recently, as we know, it launched Tira under its brand luxury beauty segment that they wanted to enter into. And Tira currently operates 5 stores currently, and plans to take it to a total of 100 in the next couple of months. Now, the big question is that once this deal falls through, what will be the strategy here? Could we see a possible facelift of Tira and Sephora in the same house of brands? If this deal had happened in 22, this plan would have been very much aligned with Reliance Retail's expansion in the retail space and the multi-brand retailing beauty space. But now with Tira as their own brand, we'll have to keep a lookout and keep a check on how things shape up for their beauty business going forward. Back to you.
Okay, Aishwarya, we'll leave it at that. It's the fight of the might within the beauty segment, and what we're picking up is that Reliance now is in the fray for Sephora. That's owned by LVMH. But Reliance holding up almost about 0.5%, and we've already seen that it's actually the retail segment which is now the most valued as per the SOTP valuations. In fact, retail is the segment which has actually, brought up the surprise in the second quarter numbers as well and delivered higher than what the street was anticipating. But let's get in some more strategies and let's talk about some more, active movers in trade. And, we were just looking at the recovery that you had on Friday. Seems like a marginal follow through definitely is in place. So Axis Bank, SBI, these were all the movers. Tata Motors, of course, was a big one. And Reliance also held out pretty strong ahead of its numbers or going into its numbers on Friday. That stock was was higher by about 1.6%. But Naresh, where do you see Reliance headed? It's 22.77, the indicative price on the pre-open.
So getting into a new range, 2200, 2250 on the downside. 2300, 2350 would be tough to cross. So for now, not expecting a major follow through. For the day, maybe closer to 2300 should be a resistance. And should not see much more beyond the 2240 mark. So for the day, I would expect 2240 to 2300 range to maintain for the stock.
Okay, let's get in some mid-cap strategies as well then on that note. Kush, what's on your list?
So ESAB India, that's a stock that I have on my list for a while now, and we've discussed this stock a couple of times on the channel as well. If you see, it's almost agnostic of what's happening in the market. Just consolidated, didn't even sort of see a correction. So this is one stock that I have on my radar. On the upside, we're looking at levels of 58, 50, and 6,000. And on the downside, 5,600 is where the support lies. So ESAB India, ESAB India, this is the stock that one could consider even from a near-term trading perspective, and also if you're looking to hold on for let's say 3 to 6 months kind of a time horizon, it's not such a bad idea to dig into ESAB India.
One ESAB India 57.79 and the stock price as of now. Naresh, what's on your mid-cap radar?
That's a buy on RBL Bank. The stock corrected well from 250.55 to 225 odd levels. Made a good recovery, so expecting this bounce to continue towards 240, stop loss at 222.
All right, there you have it. Those are some top mid-cap recommendations, but let's also focus in on what's on the editor's radar. Decent set of numbers from the likes of RIL, Tata Motors and Cipla. What exactly is the street looking at closely? Let's find out.
Reliance numbers are absolutely in line. If you look at even the verticals, marginal miss and a marginal beat. Net, the numbers are absolutely in line with the estimates. Nothing new has come out, not that market was expecting anything new or grand. So these numbers are unlikely to change the trajectory for Reliance, which is that Reliance is unlikely to suddenly emerge from an underperforming zone to an outperforming zone. These numbers are not going to do that kind of magic for for the numbers per se. The other number which I think Pharma is, in my book, I think is standing out, whether I look at Cipla or Dr. Reddy. I mean, the margin expansion, the kind of indications what we're getting in the US market, the numbers what we got from Taro and then from Cipla and from DRL, those numbers are pointing that things for the pharma space is perhaps bottoming out and it's moving in the right direction. Then you've got, Bajaj Finserv, and you've got numbers which have come from IDFC Bank. And those are good numbers, frankly. They just tell you that the financial space per se, I think, is moving from a, the growth phase is just not over. So banks really outperforming. Reliance numbers stable. in line, but they will not excite the market.
Absolutely. Well, if you thought last week was hectic when it came to earnings, it's another 14.5% of the index weightage waiting to report its numbers this week too. And you've got the big boys, Nikunj. You've got Tata Motors, Tata Steel, Adani Enterprises, Bharti, and then of course the biggest of them all, L&T, with nearly a 4% weightage on the index.
Tata Motors numbers would be crucial, and especially given that how the stock has been a ranked outperformer. And hopefully we will get some clarity as to, the net debt plan, what they had given to of becoming net debt free by 2025. Are they likely to prepone it? Because the cash flow, what JLR is now generating, I think is absolutely, amazing.
Okay, just counting down to the market open then this morning, and given the kind of weakness that we are coming out of with, and considering, the weakness was not just isolated to our markets, you had the rest of the globe as well, which was pretty weak. So let's just sum up the cues for you and the kind of setup that we have seen this morning, given that it was a near 2.5% decline on the Nifty alone, and we saw a breach of not just 19,000, but that 18,850 level as well got tested in the previous week. Of course, a rebound on Friday, and seems like a bit of a consolidation coming in this morning, at least to start off trade with right now. Lots of earnings to digest, but let me first pick up on the index calls as well this morning and tell you what our chartists are positioning in terms of where they feel the markets are headed next, index-wise. That's the call coming in on the Nifty. It's a hold from Kush Bora and a no trade absolutely from Naresh Mirani. So not quite the consensus coming in there. For the Nifty Bank, Naresh again is recommending do not trade. So no trade there, and Kush is recommending a hold. Okay, just getting set then for the market open. Lots of earnings like we've been, marking down. Let's just revisit where Reliance finally has settled in at. So, because it seems that after that initial 0.5% pop, maybe a bit of a cool off coming in there, still standing with that 11-point gain mark. L&T, Tata Motors, Bharti, these are the big earnings this week as well. Remember, 14.5% nearly weightage of the index comes out with its numbers this week. So yeah, that's going to be an important one as well to look out for. You've got Sun Pharma, Hero MotoCorp, Tata Steel, Britannia, Adani Enterprises, Titan. So it's a very critical last week of October that we're headed in. And of course, kickstarting, the festive month as well, the month of November this week too, with lots of earnings lined up. So not quite done with the earnings per se, but, purely largely the weakness that we're coming out of. I think what's going to be critical is whether or not we're able to defend breaching last week's low, that of 18,850 thereabouts. So can we really cling on to those levels or not is really the key question, and perhaps hold on to that support of 19,000. For the initial rates, it seems like, we're able to do so. So 19,063 is the print that Nifty has started off with. Although I must add, it's absolutely flat when it comes to an index move. Reliance, let's revisit what that stock is up to after its numbers, which were largely in line. Of course, a beat when it came to individual segments like retail, 1% higher for Reliance Industries as we speak right now. For Dr. Reddys too, it's been an inline set. So let's just revisit what that stock is doing, though that's down about almost 3%. Cipla numbers were good, Maruti numbers were good, SBI Live, BPCL, Bajaj Finserv was actually in line, but the rest of the numbers turned out to be quite okay and good. Lots of earnings this week. Tata Consumer, L&T, Bharti all report their numbers tomorrow. Then day after, you've got Sun Pharma, you've got Hero MotoCorp, you've got Tata Steel, Britannia. And then, of course, on 2nd November, you've got Tata Motors and Adani Enterprises as well delivering their numbers. So extremely earnings heavy. But I want to check in on what some of the newsmakers are up to. And let's start off with what AU Small Finance Bank is currently doing in trade. That stock, will just come up for you on your screens, considering that's the newsmaker really this morning. Remember, the company is looking to acquire Fincare Small Finance Bank. AU Small starts off in the red, 1.6% lower. There's Gujarat Gas as well, wherein the company has announced an increase in the industrial gas prices by almost 2.3 per standard cubic meter. So that's quite a bit of a jump. There's Ultratech Cement as well, wherein the board has approved a capex of 13,000 crore rupees to up their capacity. IFL Finance, wherein Jefferies is initiating a buy with a target price of 760. There's IRB Infra after getting that letter of award from NHAI. That stock as well has gapped up. Dr. Reddys, of course, more than the earnings, it's the US FDA issuing the Form 483 with 10 observations for their manufacturing unit in Hyderabad. That's really impacting the stock, 1% lower as we speak on DRL. Meantime, there's also NTPC. The numbers have been in line with estimates. Margins have come in at 25.7. So that's something that should go down well with the street. Even Inox Wind, wherein the losses have now narrowed both on a year-on-year as well as a sequential basis. The EBITDA has jumped into profit versus loss on a year-on-year basis right now. Route Mobile, the margins have come in at 12.6%. EBITDA is showing an uptick of nearly 24.5%. Oberoi Realty, good numbers there. Revenue uptick of nearly 77%. Margins have expanded to 52.4%. 1% higher on that stock. There's Greenlam as well. That's another stock which is in focus. The EBITDA has come up higher by 40.8%. And the margins as well have expanded to 12.5%. Piramal Pharma has been actually quite the beat. So the margins have jumped up all the way to 14% versus 10%, and it's a net profit versus loss on a year-on-year basis. Piramal Pharma has gapped up about 6% as we speak right now. There's AU Small Finance Bank came out with its numbers too. Besides, of course, the news with Fincare SFB, the NI has shown an uptick of 15.5%. MGL2 Q2 volumes, they've come in higher by about 3%. Revenues higher by 2%. So these are a couple of stocks which are reacting in the positive. But BPCL, the numbers, while the numbers were above estimates, the GRMs haven't quite matched up to what the street was anticipating. SBI Cards, M&M Finance, Blue Dart have all been a bit of a disappointment by way of earnings. But Naresh, it's a nothing sort of start for the index. Stability, yes, and Reliance holding up. What's your take, A, on where the market is headed next? And of course, any stocks that look interesting to trade?
So overall, continue to remain range bound is the view. 18,850 should hold for the day. 19,100 on the upper end. Overall, could be a time to just watch it out. Not really looking at taking a trade as of now, unless we start getting into a sharper momentum above 19,100, 200. So for now, time to just watch it.